You finally see the word excellent next to your credit score. For a second, the mortgage search feels solved. By the end of this video, you'll know exactly which numbers actually set your home loan rate, so you stop guessing and start asking the right question. $6,778. That's the gap we found between two borrowers with the same excellent score on the same size loan just because of how much deposit each one had. We pulled a major lender's live rate card and ran the actual repayment numbers ourselves. Same score, 4 different deposit sizes, 4 very different bills. This is general information only, not personal advice, so treat it as the starting question, not the final answer. It's a frustrating feeling. You did the responsible thing, paid on time, kept the file clean, and the price still moved. Honestly, that caught us out too, the first time we compared quotes side by side. A credit score isn't a mortgage menu. It's a summary of your credit history, how much you've borrowed, how often you've applied for credit, and whether you've paid on time. Think of your score as a gate, not a price tag. A clean score can open the door to a lender's mainstream offers. It doesn't decide which offer, on which loan, at which price is waiting on the other side. Two households can have identical, spotless scores and still be quoted differently. According to A6 Money Smart, a higher score may mean a lender sees you as less risky, but the lender still needs to decide whether this exact loan on this exact property fits its policy. It's easy to take a price gap personally when your file is clean. It usually isn't personal at all. It's the lender reading the whole application, not just the one number you've been watching. A clean score doesn't turn a small deposit into a large one. It doesn't erase a car repayment. And it doesn't prove your household has room to breathe once the bank stress tests your income. Here's the part that surprised us most. Lenders don't just check today's rate. APRA confirmed in May this year that the mortgage serviceability buffer sits at 3 percentage points, so a 6.49% offer can be tested as if it were 9.49%. That stress test doesn't set your contract rate. It sets the size of the loan you're allowed to ask for, which quietly reshapes your deposit percentage and the products you can actually reach. Serviceability looks at verified income, living costs, dependents, and existing repayments, even a credit card you pay off in full, because the limit itself counts as a possible future debt. Here's the lever the bank can see immediately: loan-to-value ratio, or LVR, your loan amount divided by the lender's valuation. A bigger deposit lowers that number, and it moves before your score ever gets a say. On one major lender's live rate card, the owner-occupier rate stepped up at every band, cheapest at 60% LVR or below, most expensive above 90%. Same lender, same product family, 4 very different prices. Those are product rates for new lending, not a promise of approval, and they change over time. The pattern is what matters. The bank prices your deposit size, not just your history. The lender doesn't rely on the bureau score alone. Many run their own internal model over the top of it, weighing the same application slightly differently, another reason two excellent files can land in different places. Here's a fair pushback though. Chasing a lower LVR isn't a reason to empty every account. If reaching a smaller deposit leaves nothing for moving costs or an emergency, the cheaper rate may not be the cheaper decision. So pause on this one for a second in your own situation. Would your household rather squeeze the deposit up to reach a cheaper rate tier, or keep more cash sitting ready for whatever settlement and the first year of ownership throws at you? There's a third lever most people don't think about at all: the shape of the loan. Owner-occupier versus investor, principal and interest versus interest-only, these aren't just labels, they're different risk products with different pricing. An owner-occupier loan, paid down as principal and interest, tends to feel the most straightforward. It's the product most rate cards are built around, and where a stronger deposit and a clean file work hardest together. Interest-only or investor lending can suit a specific strategy, but lenders often price the added risk in, and the balance doesn't shrink while you're only covering interest. That's the trade-off worth naming honestly. Extra features like an offset account or a redraw facility can be genuinely useful, but they're rarely free. Every feature you add is worth weighing against what it actually saves you. A feature you're paying for but not actually using is the quiet one. If the offset sits empty most months, the plain package without it can genuinely be the cheaper loan. This plays out differently depending on where you're starting. A first home buyer using a low deposit scheme might avoid mortgage insurance, But that doesn't mean the lender prices the loan as if a full deposit had landed. Wherever you live, a capital city or a regional town, the same three levers apply. The valuation, the deposit, and the loan shape do the pricing work. The postcode changes the numbers, not the rule book. The same loan can reach very different serviceability outcomes on one income versus two. It isn't a judgment on the household, it's how much surplus room is left once the stress-tested rate is applied to real living costs. But here's the exception to everything we've just said, because there is one place your score becomes a direct price tag, not just a gate. Specialist and non-conforming lenders serve people who don't fit a mainstream bank's policy. A recent credit event, unusual documentation, a thin file. Instead of declining, some of these lenders price the extra risk directly onto the rate. A recent industry guide describes specialist lenders adding roughly half a percentage point to 1.5, and non-conforming loans running 2 to 4 percentage points above standard. That's the specialist end of the market, not what a merely good mainstream file should expect. There's no shame in landing here. A specialist loan can be a genuine bridge back to mainstream lending after a run of clean repayments. It just deserves a plan, not silence. Ask how long you expect to keep it, what the fees or exit terms are, and what evidence would let you refinance later. An expensive loan you can actually settle still beats a cheap-looking one that declines you. Self-employed income and a shorter credit history aren't the same as a bad file, they're often just a thinner one. That's exactly why the documentation and loan shape you bring can matter as much as the score itself. So let's put a real number through it. Take a $600,000 loan, 30 years, principal and interest, and run it through those 4 deposit tiers we saw earlier. At the cheapest tier, the yearly repayment is the lowest of the 4. Climb to the smallest deposit tier on the exact same loan, and the extra cost stacks up to that $6,778 gap we opened with. That's a first-year difference, not a lifetime total, and real variable loans move over time. But it shows how much weight sits on the deposit lever, often more than the score itself. Scale it down to a smaller loan and the shape holds. The dollar gap shrinks with the loan size, but the same deposit tier story sits underneath every borrower, not just the $600,000 example. This is the part that's easy to miss when you're proud of a clean file. The deposit gap can cost more every single year than the difference between an okay score and an excellent one. Same score, 4 different applications, 4 different outcomes. It isn't a report card grade. It's a live read of the deposit, the surplus, and the loan you're actually asking for. There's one more trap worth naming gently. Firing off several formal applications to shop for a better rate can leave its own mark. Money Smart notes that applications sit on your report, and a lender can see how many you've made. The gentler version is checking with a broker or 1 or 2 lenders informally first, then narrowing to a smaller number of formal applications once you know roughly where you'll land. A broker who works across a panel of lenders can do some of that comparing in one appointment, but the same 6-field sheet still applies, however you end up gathering the quotes. None of this means the plan is off the table. It means the $6,000 gap belongs in your planning, not in the surprise pile on settlement day. You can't control where the market sets rates this month. You can control your report, your deposit planning, and how clearly you document your income, and those 3 genuinely do most of the real work. So here's the practical version. Before you compare 2 from rates, build one simple sheet with 6 fields so you're comparing the same loan, not just the same headline number. First, your credit report itself. Check it for errors, late payments, or unfamiliar inquiries before you apply. Second, the lender's likely valuation and the LVR band it lands in, written beside every quote. Third, the purpose and repayment type, owner-occupier or investor, principal and interest, or interest only. Fourth, the serviceability inputs the lender actually used, including how it treats your income and any credit card limits. Fifth, the rate, the comparison rate, and the fees or features attached. Sixth, and this is the one most people skip, what changes at the next LVR threshold and whether the lender will reprice you later. Then ask your lender or broker one sharper question than, is my score good enough? What tier does this exact application reach, and what would move it to the next one? That's the whole sheet, 6 honest fields, filled in the same way for every quote you collect, so the cheapest looking number can't hide behind a different loan underneath it. One more honest note, some lenders price a new loan from your starting LVR and don't automatically adjust it as your balance falls. Paying the loan down is still valuable, it just might need a phone call to actually show up in your rate. If your balance has dropped or your property's likely worth more now, a low-pressure review call is worth making. Bring your current rate, your estimated LVR, and one comparable quote. A cheaper rate elsewhere is only a real win once you've weighed exit fees, new establishment costs, and the hassle of switching against what you genuinely save each year. None of this is a push to strip every account bare for a lower rate tier. A slightly higher rate with real breathing room can still be the stronger household decision. The score was never irrelevant. It's just one input on a sheet with 5 others, and now you know what the rest of that sheet actually looks like. Before your next inspection or pre-approval call, do one small thing tonight. Put your likely loan amount and the lender's valuation beside your deposit, work out the LVR, and ask which tier that exact application reaches. It's a far more useful number than a credit score brag. Once you can see the trade-off in front of you, deposit, buffer, loan shape, you're no longer guessing at a price. You're choosing one. If this helped map your next quote comparison, subscribe. We put out one of these guides every week.